pardon my French, but there have been a lot of really stupid takes going viral lately about the Fed, interest rates, mortgage rates, Jerome Powell, the economy. And if you repeat any of these, you will sound like an idiot. So I'm going to set the record straight and save you from the embarrassment before it happens. Plus, let's be honest, these things may not be your area of expertise or even something you really care about that much, but they do have an impact on your life, so it probably wouldn't be the worst thing in the world to understand the basics of how they work. I promise this will be nothing like your boring high school economics class that you hated and forgot everything from. I'll keep it concise, interesting, and relevant. Let's start with the ultra basics that a lot of people seem to still be missing. Who the heck is Jerome Powell? What is the Fed? And what do they actually do? Well, Jerome Powell is the chairman of the Federal Reserve, often referred to as the Fed for short, which is the central bank in the United States. The Fed has two main objectives: to promote maximum employment and stable prices. They try to balance these objectives mainly by controlling monetary policy, like setting the target for short-term interest rates that banks use to lend to each other overnight. Trump has been highly critical of Jerome Powell, recently calling him a moron and threatening to fire him for weeks because he wants him to lower interest rates, and he hasn't. That's leading to tweets like this one that has been seen over 1 million times and retweeted over 11,000 times, but says it's absurd that one man sets interest rates. Yes, that would be absurd, but fortunately, it's not how the Fed actually works. You ready for some ultra basics that will blow a lot of your minds? Jerome Powell does not set interest rates. What? But everybody says, yeah, I know. But interest rates are actually set by the Federal Open Market Committee, aka the FOMC, which is comprised of 12 voting members. Jerome Powell is just one of them. And in all the recent votes on interest rates, you know how many of the members have been voting to lower rates? Only 2. So 10 out of 12 people have been voting not to lower rates. If you replace Powell with someone who wants to cut interest rates, they'd still be outvoted 9-3. If people just understood that really basic fact, it would save millions of people from being exposed to blatantly false information, sounding like real idiots in public, and calling for actions that would risk sending us into another Great Depression. Yes, I am being 100% dead serious with that, and we'll get to how that might actually happen in a few minutes. But before we dive into that, one simple thing that continues to blow my mind is that 74% of you that watch this channel regularly haven't yet subscribed to it. So can I ask you for a favor before we continue? If you like this channel and you're getting value out of it, you want to support us. The free and easy way to do that would have a massive impact on our lives and cost you nothing is by simply hitting the subscribe button. My commitment to you is that if you do that, my partner Cal and I will continue doing everything in our power to help you sift through the BS and become a better investor. Thank you so much. Now, another crazy idea that I've been seeing out there more and more is that Jerome Powell is politically motivated and he's keeping rates high to hurt Trump. This is done for many reasons. First of all, let's not forget that Trump is the one who appointed Jerome Powell, even though he seems to have forgotten that minor detail.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him. It is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve.
So, one thing you should know is that when the Fed cuts interest rates, it's usually good for the economy because it makes it cheaper for businesses and people to borrow money. It also lowers the interest rate on future U.S. debt, which there's going to be a lot of. So those are two reasons that Trump wants the Fed to cut rates. Now, to prove that Jerome Powell is politically motivated, a lot of people are saying he's keeping rates high to harm Trump, and he cut rates in 2024 to help Biden. So let's take a look and see if there's any truth to that. Now, we already know this makes no sense because Powell does not actually set interest rates himself, but this claim is even more ridiculous than it would be for that reason alone. Here's the Fed funds rate, the only rate that the FOMC sets during Powell's tenure at the Fed. Since people are saying Powell was trying to influence the election, I started the highlighted section when he first took over as chairman, which was in February 2018, and then from there, I ended the Trump and Biden periods at each election. You can see over the course of Trump's first term, under Powell's leadership, the Fed actually lowered rates basically as much as they possibly could until they were practically zero. And then in Biden's term, they raised interest rates to their highest level in 40 years. Yes, they did lower them slightly from their peak before the election, but they also kept lowering them after the election. If they were really trying to raise rates to hurt Trump and lower rates to help Biden, I would say they did a pretty horrible job of that, seeing as how they significantly lowered rates in Trump's term and raised them in Biden's term. People are also saying that Powell should be fired because the Fed didn't lower interest rates despite incredible economic numbers. This is like saying someone should go on a diet because they're too skinny. It literally makes no sense. Do you know why the Fed cuts interest rates? This guy who got almost 2 million impressions on his tweet seems not to. Incredible economic numbers are basically the last thing that would get the Fed to cut interest rates. Remember their two objectives. The first one is to promote maximum employment. Monetary policy can help do this because if interest rates are lower, it's cheaper for companies to borrow money and thus hire more workers. That's why, usually, they lower rates in a recession. If we have incredible economic numbers, that is the last time they would want to cut interest rates. This is also why they did cut interest rates so quickly in 2020, because we were entering a recession. And that's also why they raised rates a lot in 2022 and 2023, because we had rising inflation. It had nothing to do with political support for one party or another. The Fed is independent, and it is imperative for the future of the United States that it stay that way. But I'm getting a little ahead of myself. We'll get more into that in a minute. Trump and his echo chamber are also saying that the cost overruns of a remodel project at the Fed's headquarters are another reason that Jerome Powell should be fired. And I hate to call out Rand Paul here because I normally like a lot of the things that he says, but this is honestly a really ridiculous take. And I guess to be fair, he's definitely not the only one saying this. All of the things I mentioned in this video are widely out there on the internet. This is ridiculous for two reasons. First of all, Jerome Powell is the chairman of the Federal Reserve. He's not the project manager who's estimating construction costs and procuring materials or hiring workers. Would you really think he's down there at the construction site telling people not to work so hard or picking out tiles for bathrooms? I highly doubt it. And second of all, while we're on the topic of cost overruns, I wonder how much this 90,000 square foot gold ballroom in the White House is going to cost. That seems necessary. And how about the big, beautiful bill that Trump just signed into law, which will increase the national debt by more than $3 trillion over the next 10 years? That's roughly 6,000 times more cost overrun than the Fed's remodel of its headquarters. And Trump directly approved that budget, and that's before there are any cost overruns. I mean, are people even serious when they say that's a reason Powell should be fired? Honestly, I don't even know anymore. But the idea is out there a lot, so I had to address it. Another common misconception is that the Fed's decision to keep interest rates high is the reason mortgage rates are so high and it's so hard to afford a house. Now, I understand the logic here, but a key thing to understand is that the only interest rate that the Fed controls is the Fed funds rate, which is the overnight, as in like 1 day, interest rate that banks use to lend to each other. Everywhere else in the market, interest rates on things like bonds, savings accounts, mortgages, car loans are driven partially by that rate, but in many cases, they're driven much more by other factors, and mortgage rates are one of those cases. In this chart, we have 30-year mortgage rates in blue, 30-year Treasury rates in orange, and the Fed funds rate, which is the one that the Fed sets, in black. The first thing you should notice is that the shape of the blue and orange lines are much more closely related, which tells you that long-term interest rates, not short-term interest rates like the one that the Fed sets, are what drives mortgage rates. And that makes perfect sense if you think about it. When you buy a 30-year Treasury bond, you're loaning money to the government for 30 years. When you buy a 30-year mortgage bond, you're loaning money to people for 30 years so they can buy houses. No matter how good someone's credit is, they'll never be able to literally print money to pay back their debt. The government can. So all bonds to all non-government borrowers who can't print money to pay back their debt should always have higher interest rates than the government would pay to borrow money for the same amount of time. That's why the blue line, 30-year mortgage rates, is always higher than the orange line, 30-year treasury rates, because they're both 30-year loans, but the government can print money to pay their loans back, and of course, mortgage holders cannot. The second thing you should notice is over here on the right. Just last year in 2024, the Fed started cutting interest rates. That's the black line. But long-term interest rates and mortgage rates went up, not down. So, what does that tell us? Forcing the Fed to cut interest rates would not necessarily cause mortgage rates to go down and make houses more affordable. In fact, probably the opposite, like we saw last year. You know why? Because there are two real causes of rising long-term rates and thus rising mortgage rates, and neither of them is the Fed. The first is concerns about elevated budget deficits, like the excess borrowing in the big beautiful bill that we just talked about a couple of minutes ago. And the second, I'll just read this quote directly from Guggenheim, which is a bond investment manager, because they phrased it perfectly. Treasury yields have increased amid heightened trade, fiscal, and geopolitical uncertainty. This trend is likely to persist until a policy clarity emerges impacting Fed monetary policy. So, what does this tell us in plain English? If Trump wants mortgage rates to go down, he has the power to make that happen, not Jerome Powell. He needs to reduce government spending and stop with the constant tariff threats. If he does those things, long-term interest rates and thus mortgage rates will probably come down a lot. It would also lower inflation, which would be what the Fed needs to see before they start cutting rates too. So, what's the real reason the Fed hasn't lowered interest rates this year? It's not that Jerome Powell is some sort of a political operative with trunk derangement syndrome or any of the crazy theories that are out there. And yes, he has given a very clear explanation for why the FOMC has not voted to lower interest rates and what it would take for them to do that, despite what some people might say. Let's break it down in three very, very simple steps: what guides them, how those things have been going, and what they're expected to do in the future.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Okay, there's number one. They're focused on their two main goals: maximum employment and stable prices, what they're always focused on. So, how are those two things going? Starting with the first one.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
Okay, so why does the Fed lower rates? To strengthen the economy and get the labor market back to maximum employment. But the economy is strong already, and the labor market is already at or near maximum employment. So no need to lower rates. And how about stable prices? How are those doing?
Inflation has been running somewhat above our 2% longer run objective.
Why does the Fed raise rates? To bring down inflation. And inflation is already higher than their target. So why would the Fed lower interest rates? If anything, they should be raising them. Lowering them would make no sense at all. And how are these things looking going forward?
Although the underlying composition of price changes has shifted, services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures.
So inflation is up, actually straight up since Trump started putting tariffs in place, and basically everyone expects it to keep rising. And that was before Trump announced significantly more tariffs, which was scheduled to take effect on August 7th. Or maybe they won't. Or maybe they'll go on for a week and then get paused or lowered. But the Fed reacts to data, and the only way they'll lower the Fed funds rate is if inflation cools off and or the jobs market gets a lot weaker. And hey, maybe that second part will happen sooner than we thought, because the day after Powell made that speech, the last 2 months of estimated job gains were revised down significantly. But there's one job loss that will not help lower interest rates, and that's Jerome Powell's. All of these calls to fire Powell and end the Fed are extremely misguided and would backfire massively. Short-term interest rates are driven by the 12 voting members of the FOMC. Long-term interest rates are driven by things like long-term inflation expectations and growth expectations. But that is taking for granted that U.S. Treasuries are always considered safe because there's a strong level of trust that the government won't do anything crazy. The more crazy stuff they do, the bigger the risk that they'll break that trust. To understand why this is, let's imagine you have a close friend. Say they work in a seasonal job and they make all their money in a few months of the year. And every year in the off season, they borrow money from you to help keep them afloat. And then every year when they're working and making a lot of money, they pay you back. But then one year, they develop a drug problem. Would you still feel as comfortable loaning them money? My guess is no, even though they'd always been good for it in the past. And hey, maybe you'll still do it, but at a minimum, you'd at least be a little more cautious about it, right? Well, that's exactly what investors are doing with the US government. They're demanding higher interest rates to be compensated more for taking on the risk of loaning money to the government because the government is behaving erratically. But so far, that's mainly just been extreme tariff policies, and people are worried about future debt, future explanation. But it's been enough to drive up inflation and uncertainty. It's been enough to make long term bond yields go up. It's been enough to keep the Fed on pause, but it hasn't been enough to totally destroy the foundation that makes this country great. If Trump were to fire Powell, that would signal the end of Fed independence and lead to a massive loss of faith in U.S. assets of all kinds. The stock market would likely crash. Long-term interest rates, like the ones that drive mortgage rates, would skyrocket. The dollar would also weaken, making our imports even more expensive and boosting inflation even more. In short, it would be a complete disaster. That is why, thankfully, I think it is really unlikely to happen. Hopefully, I'm right. Now, when it comes to ending the Fed, that would not just lead to a major market downturn, but it would mean that the next major market downturn, regardless of what caused it, would be much more likely to put us into another Great Depression. One of the reasons we had the original Great Depression in the 1920s and 1930s was that we didn't have the Fed in its current form. Their mistakes back then made it clear that they needed to do more as a lender of last resort in future crises. And it also led to the establishment of things like the FDIC, which insures bank deposits up to $250,000 to help prevent bank runs, and the FOMC, which we talked about earlier. They set the country's monetary policy. Those lessons they learned were widely credited with preventing a second Great Depression in 2008 when they bailed out the banks, lowered interest rates to zero, and bought up a bunch of treasury and mortgage bonds that no one wanted so they could keep the banking system and economy functioning. I think COVID in 2020 and even the Silicon Valley bank crisis in 2023 would have been much worse if they had not stepped in immediately to stop the bleeding. Trust me, we do not want to get rid of the Fed. It would set the stage for the worst economic crisis that any of us have ever experienced. So to recap, here are the 5 main points that you need to know. 1, and if you only remember one thing from this video, it should be this. Jerome Powell, or whoever the Fed chair is at the time, does not set interest rates by himself. Interest rates are set by the 12 voting members of the FOMC. Number 2, also very important, the Fed only sets the Fed funds rate, which is the overnight rate that banks use to lend to each other. Long-term interest rates are much more heavily influenced by inflation expectations, growth expectations, and investors' faith in U.S. assets. Number 3, Trump has the ability to lower long-term rates, which are the only ones you should really care about anytime he wants. Powell does not. In order to do that, we need some combination of lower tariffs, lower government spending, and or generally less erratic and unpredictable economic policy. Number 4, the Fed is independent. They do not care about politics, and if investors ever believed that they could be influenced by the president, it would lead to a loss of faith in U.S. assets and almost certainly send long-term interest rates on things like business loans and mortgages significantly higher. And number 5, the Fed doesn't just set monetary policy, they also act as a lender of last resort to help save us from crises. Without them,
it's over. We are screwed.
If you found this video helpful or learned something, or just enjoyed hearing about the Fed for the first time without falling asleep, hit that like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. It's been a pleasure. Thank you so much for watching, and I'll look forward to seeing you in the next one.